Welcome back. A couple of weeks ago, I looked at Peloton in the context of how VC pricing might have gone off the tracks with both WeWork and Peloton, and drew some general lessons about VC pricing. In this session, I'd like to look at IPOs again, but this time I'd like to look at the lessons we can extract from IPOs as public market investors. This has been a big year, 2019, for IPOs. The start of the year, there was tremendous enthusiasm about the companies that were going to go public this year because there were some big names coming down the pipe. And many of those big names have gone public. But while they've been able to raise the capital they wanted to, there's been a bit of a disappointment in the aftermarket, especially in the last couple of months. WeWork, of course, was the most extreme example of a disappointment. But as these companies have disappointed, people have tried to extract some debate, some discussion about big questions, such as, should public market investors base their pricing on the most recent VC round? Should the IPO process itself be restructured? Are bankers even necessary? What share count should you use to convert the share price into a market cap? And when investors go into this game, should they even try to play the IPO game, or is it too dangerous? I'm not going to try to answer all of those questions, but I'll try to answer some of them. So let's take a snapshot of what the IPO market has done in 2019. There have been about 190 initial public offerings, or there will be by the end of this year. So that's a lot of IPOs. And I can't track all of them. But there is a simple way in which you can see how IPOs in general have done relative to the market. There's an ETF on IPOs called the Renaissance IPO ETF, which basically invests in not all IPOs, but the largest market cap IPOs. So basically, the IPOs invest in account for about 80% of the market cap of all IPOs. So if you look at the performance of this fund, you're getting a snapshot at least of the performance of IPOs relative to the market. So if you look at the green line there, you can see how IPOs have done collectively during 2019. And notwithstanding all of the bad press you've read about IPOs, IPOs have actually outperformed the S&P 500 over the course of this year. It is true that much of that overperformance has happened in the first 6 months. And in the last few months, you've seen a giving back, but it's not been a bad place to invest. A caveat on reading too much into this graph. The Renaissance ETF actually buys IPOs and holds them for 500 trading days after it buys them, or tracks them for 500 days. So what this can create is a spillover from IPOs that happened a year ago, maybe even as long as 2 years ago. So it's a little bit of a contamination effect, but overall, maybe the news about IPOs is not as bad as it looks. So to take a closer look, here's what I did. I decided to focus on 7 IPOs. And these are 7 IPOs that I've actually valued at the time of the IPO. Many of them I wrote blog posts on, which you can find, and I've done YouTube sessions on that you can find if you do a search. And these are my 7 companies. The first is Levi Strauss, because I wanted to pick a company that's an old company that went back public. So I'm going to use Levi Strauss. Lyft and Uber are in there simply because they were big name IPOs that happened in the first half of the year. Pinterest, classic technology IPO. Beyond Meat, the biggest success of this year, but a very unconventional. It's clearly not a tech company. It's a food company. Slack, which is a communication software company. And Peloton, which is, of course, an exercise company. So very different companies. All 7 went public this year. I've listed the date on which they went public, the number of trading days since then, through October 8th, which is when I did this analysis, the offering price that was set by the bankers at the time of the offering, the open on the first trading day. This is the first price at which they were traded. And if you just pause there, you can see, for instance, Levi Strauss's offering price was 17. Its first traded price was 22.22. And on every single one of these companies, except for Uber, the first open price was higher than the offer price, which this of course creates a whole set of debates for founders, because by doing this, bankers are in fact leaving money on the table. But to the extent that on the initial offering day, you're not offering 100% of the shares, founders might go along with it. So that's a jump you see on the open. For most of us outside investors who are not able to get the shares at the offer price, the open is the first time you can actually buy these shares. I've also tracked three other prices. One is at the close of the first trading day. The second is the close 10 trading days later. The third is the close 50 days later. And finally, I looked at the stock price on October 8th of 2019. And if you look across the companies, you notice that there have been some disappointments, especially in Uber and Lyft. Uber, which had an offering price of 45, is trading at about 29. Lyft, which had an offering price of 72, has almost halved. It's trading at 38.86. Pinterest, which had an offering price of 19 and jumped to 24, is pretty much stagnated. Stock price is 25.63. Beyond Meat has kind of zoomed beyond anybody's expectations. The offering price was 25 and almost doubled on open. It almost tripled by the end of the first trading day. And it's been almost unstoppable since. In fact, it's dropped off a little in the last few weeks, but it was trading at $143 on October 8th of 2019. Slack, which went public, which had an offering price of 26, had a big jump on the opening day to 38.50. It's given back a big chunk of that opening day profit. In fact, it's trading at below the offering price now. Peloton has been a disappointment. So I said only one stock has opened below the offering price. I was lying. Peloton also opened below the offering and has slipped, but it's been traded only 10 days. Now, if you look at the percentage returns, the easiest way to make them all comparable is to think about investing $100 in each of these IPOs and track them over time. The winner here is obvious, Beyond Meat. The remaining 6 companies have kind of drifted around. A couple have made a little money, a couple have lost significant amounts of money. But this is the percentage return from the open price, not the offer price. I could do a similar graph around the offer price, but I think the open price is a more realistic number as public market investors to focus on. So I'm going to use what we've learned from IPOs this year to draw some general lessons for public market investors. Here's the first one. I talked about how VCs price companies. They don't value them. Well, here's what we need to understand. Once these companies go into the public marketplace, at least initially, it stays a pricing game. Let me back up and talk about the difference between the pricing game and the value game. The value game, we know what drives the level of value. It's cash flows, growth, and risk. The pricing game is driven by demand and supply. And when you see value change, it's going to be because one of the fundamentals changed. Cash flows went up or down, growth increased, risk went up. But in the pricing game, it's changes in mood and momentum that are the key driver for why the price changes. The players in the value game I call investors. Investors, value a company, look at the price and hope for convergence. That's how they make money. In the pricing game, the players are traders. They make money by buying at a low price, selling at a higher price. They play the momentum game and shifts in that momentum. The key skills you need to play the value game is first, you need to be able to get values for companies. And second, you need faith to hold on as the price adjusts and perhaps find catalysts that cause the price to adjust to value. To play the pricing game, you got to be able to gauge market mood and momentum and detect shifts in that mood ahead of the rest of the market. What are the personal characteristics you need to win at the value game? You need a long time horizon, you need patience, and you need immunity from peer pressure. In other words, you'll be holding stocks that everybody else hates, and the reverse will often be true. You'll be selling stocks that everybody else loves. If you play the pricing game, your key characteristics is your time horizon has to be flexible. Short, sometimes it can be minutes, sometimes months, sometimes years. You have to have good gambling instincts, and I mean that in the best possible way, and you've got to be able to read crowds. And if you think about the tools in the value game, it's traditional intrinsic valuation, discounted cash flow valuation, accounting, especially forensic accounting. In the pricing game, it's about peer group pricing. Can you figure out who the market is pricing your company against? And perhaps even charts and technical indicators. Very different games. The IPO game is a pricing game. And here's why. The process of IPOs is one of gauging demand and supply. You know how IPOs work, at least the way it's structured now. If you're a company that wants to go public, you get a syndicate of bankers together with a lead banker. And what do? They don't value your company. In fact, all they do is they gauge demand and supply. By doing what? By calling portfolio managers, checking out prices to see how enthusiastic portfolio managers may be at a price. It's no more complicated than that. The process is driven towards pricing because you got to sell those shares in the offering day. There's a self-selection process. The kinds of investors who get drawn into the IPO game tend to be people with shorter time horizons who want to make money quickly, who believe that they're better at detecting shifts in momentum than the rest of the market. So in effect, investors are pushed out, traders are pushed in. And finally, the types of companies that generally go public tend to be younger companies, earlier in the life cycle. You're saying, what? So what? There's a lot more uncertainty about the future, and that scares away people who want to value companies. They leave the market to the traders. So IPO games are trading games because of the way they're structured, because of who comes into them, and because of the kinds of companies that are in the game. So what you might ask, well, first, don't try to explain price movements at IPOs on a day-to-day basis. If you try to explain price movements on Beyond Meat or Uber or Lyft based on what happened that day, you're going to drive yourself crazy. Because what drives these stocks might, as I said, be something trivial, something you look at and say, really, that's what caused the price to move? Or maybe not even news, just mood and momentum shifts. And be very careful. Playing the pricing game, you're like riding the back of a tiger. One day you're riding the back of the tiger. The next day you're inside the tiger. You've got to be careful to detect shifts in mood and momentum. The second lesson from these IPOs is it's a pricing game, but the pricing starts with a very shaky number. Because remember, when you price publicly traded companies, what you do is you find the peer group for those companies. If you're valuing Coca-Cola, you look at other beverage companies. You have a history for the company. You can look at the past stock prices and the peer group to do your pricing. Now think about doing this in an IPO. First, many of these IPOs often claim to be new businesses. It's in their best interest to claim that to be true. They try to frame what business they're in to get a higher pricing. Does it surprise you that every company that's gone public this year claims to be a tech company? Well, is WeWork a tech company or a real estate company? Is Uber a tech company or a transportation company? Is Beyond Meat a tech company or a food company? By using the word tech, they're trying to reframe who you compare them to because it'll give them a higher pricing. The second is, when you look at past pricing for an IPO, what you often have are VC rounds, and that's a shaky basis, and here's why. Let me use my 7 companies to illustrate this process. What I've collected in this table is the number of rounds of funding each of these companies has received, how much funding they raised, what the last VC round delivered as a pricing. And the way this is done is very simple. People look at what VCs invested and what percentage of the company they got in return, and they extrapolate from there. So if you paid $50 million for 5% of a company, they assume that the company must be worth $1 billion. You're saying, so what? That sounds reasonable. Well, here are some of the reasons you should be a little cautious about VC pricing. First, you're extrapolating from a small investment. I'll give you an example that's not on this list. A few weeks ago, or maybe 2.5 weeks ago, I saw a news story about Stripe. It's a payment processing company, a very promising company, where a $200 million investment had been made for less than, for maybe 4% of the company. And people extrapolated from the 200 million to a $50 billion value. Well, when you have just a small investment, you have no idea how that investment is structured. And what makes this worse is most VC investments are not clean investments where you invest money and you get a percentage of the equity. You also get protections. One example of a protection is many VC investors, when they invest in a company, if the next round delivers a value lower than the value that they invested, are allowed to get additional shares of the company. They're given protection against downside. Put differently, they're getting a put option with their investment. What does this all mean? Well, it means you cannot extrapolate from the 200 million to a $50 billion value. In fact, I have posted before about how you can make a $5 billion company look like a $20 billion company by giving the VC enough protection that that the extrapolation delivers a much higher value. And finally, remember, you're basing this on one trade because the most recent VC round was one VC. You're saying, so what? Well, VCs are human beings. Sometimes they can get caught up in the story, push up the prices because they get too over-enthusiastic, irrationally exuberant, if you prefer that word. I mean, think of WeWork. The $47 billion pricing came from SoftBank. In fact, the bulk of the pricing increases at WeWork came from SoftBank getting excited and throwing money in. So all you need is one crazy VC in this process to drive the pricing off the tracks. So that's the second lesson. When you build pricing off of VC pricing, you may be asking for trouble. Here's the third one. Think of how we compute market cap for a publicly traded company. We take the share price, we multiply by the number of shares outstanding. You think, so what? That's the way we always do it. Well, that might get you into trouble with young companies, especially the ones going public now, for two reasons. One is many of these companies have multiple classes of shares. Many have two, some have three, some have as many as four classes of shares with different voting rights. You're saying, so what? When you compute market cap, you have to include all of those shares with those classes of shares, even if some are not traded. Second, and this is tricky, remember these are young companies. They have a cash problem. They're growing fast. They don't have cash flows. And the way they hire and keep employees is by paying them with equity. You're saying, so what? In the process, these companies create restricted stock units, which are shares that cannot be traded for a certain period, and options. When you're computing market cap, you have to incorporate those restricted stock units and options, or you're going to get a number that's really not a meaningful number. Let me give you an example. A couple of weeks ago, Peloton went public. And if you looked at its prospectus, Peloton listed itself as having 41.8 million shares of Class A shares, most of which would be in the initial offering with lower voting rights, and 235.9 Class B shares with higher voting rights. If you add those two numbers up, you come up with 277.7 million shares. And most of the computations of market cap that I've seen since Peloton went public use that share count. For instance, journalists in describing the offering, the original offering price was $29, estimated that $29 times 277.7 million would be about an $8.1 billion value. But Peloton in its own prospectus lays these numbers, it shows you that these numbers are not right. And here's what it says. It says that, it specifically states it, that the number of shares does not include 64.6 million shares of Class B common stock in the form of options to purchase these shares at $6.71. Stop and pause just a moment. There are 277.7 million shares, but there are 64.6 million options waiting to be exercised at a strike price of $6.71. Remember, the offering price is $29. In what universe can you ignore these 64.6 million shares? In fact, I'm going to even ignore the additional 883,550 and 240,000. Just focus on the 64.6 million. You can't ignore those shares. In fact, when you're multiplying the share price by that share count, you're acting like those options are worthless, and that is not true. You're saying, so what? Am I making a big deal about this? Let's assume that the Peloton bankers really wanted to value the equity at $8.1 billion. If they wanted to get to that $8.1 billion, you cannot just ignore the options. You got to bring them in. So I'm going to consider two possible scenarios. One is that the bankers wanted to come up with an equity value of $8.1 billion and screwed up on the price. And the second is that the bankers knew what they were doing, but the journalists screwed up. So let's take the first scenario. Let's assume that the bankers really wanted to value Peloton's equity at $8.1 billion. Here's how the per share price would have to be computed. First, if in a perfect world, you'd value the options and subtract them from 8.1 billion, but you'd have to use an option pricing model. But here's a shortcut. Take the 64.6 million options you have and assume that they get exercised, right? 671, they're going to get exercised sooner than later. That exercise is going to bring cash into the company. So I'm going to add it to the numerator and then divide that by the total number of shares that will be outstanding after those options get exercised, which will now include the 64.6 million options. The value per share that I would get would be 24.93. So if the bankers had really meant to value the equity at 8.1 billion, the share price that the offering price they should have said should have been less than 25, not 29. But maybe the bankers knew what they were doing. Maybe they did incorporate options into the 29 per share value. Well, let's say that they were right and the journalists just screwed up by using the wrong share count. The imputed market cap then in a $29 offer price would be the following. You'd multiply the 277.7 million shares at $29, plus you would take the exercise proceeds. Again, I'm using the shortcut. In reality, if you wanted to do this right, you'd have to value them as options. And even if you took them at exercise value, which undervalues the option, it ignores the time premium, the value you get is $9.5 billion as a market cap. You're saying, who cares? Remember, in multiples, we take price earnings ratios or EV to EBITDA. If you're computing the EV to EBITDA for Peloton, the market cap you should be using should be 9.5 billion, not 8.1 billion, which means it's a lot more expensive than it looks. And this is going to be true for a lot of these young companies. Final IPO lesson. As I go through this process, I've kept emphasizing that the IPO pricing, IPO is a pricing game. It's not a value game. But in every one of these IPOs, I've done something that doesn't seem to be consistent. I've actually valued these companies using an intrinsic valuation. And I said, this is a game where nobody cares about value. And that's probably true. If you're a trader, you should ignore all of my DCF valuations. You shouldn't even do any of your own. Why bother? Because trading is about detecting mood and momentum. I'm not a trader. Not because I don't want to be. I would love to be a great trader, but I'm a terrible trader. I think of myself as an investor, which means that I have to believe, and this is just a faith that I have, that the truth eventually wins out, that these are investments in companies that have businesses, and the businesses ultimately can't just be delivering more users, subscribers, or revenues. They have to deliver earnings and cash flows. And I believe there will be a day of reckoning. I call this a bar mitzvah moment, where companies that have been giving the market what it wants, more users, more subscribers, one day the market wakes up and asks, when are you going to make money? I call it a bar mitzvah moment because many companies failed that test. The really good young companies are ready for the test because they're always run on two parallel pathways. One is delivering what investors want, more users, more subscribers. But while they're doing this, they're building a business model. So when you look at the great tech companies, the Facebooks, the Googles, the Amazons, those companies have always played the pricing game well, but they've also been ready for the bar mitzvah moment. When Twitter was confronted with its bar mitzvah moment in 2014, I remember writing about how it failed at bar mitzvah moment because its reaction to when the market asked the question, when will you start making money, was, hey, we're supposed to make money? We didn't know that was true. So there will be a bar mitzvah moment, and that's what I'm preparing for when I value these companies. So I value these young companies, and I can see some of you already shaking your heads and why would you bother? It's so much easier to value Coca-Cola than Uber. Why are you wasting your time dealing with this uncertainty? And I'll tell you why. You're absolutely right. It's far easier to value Coca-Cola than it is to value Uber. But the ingredients that make it easy for you to value Coca-Cola exist for anybody valuing Coca-Cola. So here's my question. You can value Coca-Cola more precisely than you can value Uber, but so can everybody else. I would rather get an imprecise valuation of Uber than a precise valuation of Coca-Cola, because most people are not even trying to value Uber. Their reaction is, too much uncertainty, I'm not going to try. I describe this as going where it's darkest, because often this means valuing companies in the face of uncertainty. So you might think it's crazy, but for me, this is how I think about investing. So these are my valuations of companies, and they reflect my stories. They come with all the caveats. I'm not asking you to do anything based on these valuations. In fact, you can download the spreadsheets I have, change my story, and make it your own valuations. But here are the valuations I did for my 7 companies at the time of the IPO, and I've compared that value to the open price. Again, not to the offer price. And you can see at the time of the IPO, Levi Strauss and Pinterest were close to fairly valued. All of the other companies came out as overvalued. So when I valued these companies at the time of the IPO, the price was much higher than the value. I've tracked them in the months since, and you can see that things have changed. Levi Strauss, which was close to fairly valued, is now undervalued. Lyft and Uber, which were overvalued, have become significantly undervalued. Pinterest and Slack, which were overvalued, have become. Pinterest, which was undervalued, has become slightly. It was fairly valued, is still fairly valued. Slack, which was significantly overvalued, has become close to fairly valued. Peloton has had only 10 days to play, but it's become less overvalued. And Beyond Meat, I can't even explain it. It was close to fairly valued at the time of the IPO. It's now 3 times the value. Now, there's no point to doing valuation if you're not willing to act on it. So here's what I did. And again, this is not something I'm pushing on you. This is for me based on my numbers and my valuations. I bought Levi Strauss at 1896. In fact, I bought it right after its most recent earnings report, which to me didn't include anything which would lead me to rethink the fundamentals. The stock price though dropped to $19 or 1896. I bought Levi Strauss at 1896. I struggle with Uber and Lyft. I don't want them both in my portfolio. So I thought about, should I buy Uber or should I buy Lyft? Lyft is actually more undervalued, at least based on my valuation. But I ended up buying Uber for two reasons. One is I think it's got more upside. Its global ambitions give me more of a tail on the distribution. So in addition to getting the undervaluation, I get that upside. Think of it as optionality. The second is I don't like these multiple class of shares, and I prefer Uber's single class of shares to Lyft's multiple. So I ended up buying Uber at $30 per share. Slack and Pinterest are getting close to fairly valued, and they might be just one shock away from being buys for me. Peloton is still overvalued, and I'll watch it because it'll be interesting to see, especially as the year goes on and the first earnings reports come out, how these three stocks do. With Beyond Meat, I'm not even sure what to do. I found it overvalued at the time of the IPO. I found it overvalued, and I didn't do a thing. This time, though, I think I'm going to do something that I seldom do. I tried selling short on the stock, but I was unable to get my trade through, partly because, this is one of the most difficult stocks, most expensive stocks to short sell right now. And here's what I did, which I seldom do. I bought a 2-month option, a put option with a $120 strike price, paying this absurdly high price as a time premium. I'm breaking some of my own rules here because with intrinsic valuation, you usually have to give time as your ally. I'm giving myself 2 months to play. But here are the two reasons why I think Beyond Meat might be ripe for me to do a short-term intrinsic value bet. First, the listing of Impossible Foods means that Beyond Meat is no longer the only game in town if you want to make a macro bet on people becoming more vegan or vegetarian. Second, a couple of months ago, at the end of August, Beyond Meat made an issue of 3.25 million shares, with 3 million shares coming from insiders to the market. Now, this is something that there might be other reasons for doing it, but the very fact that insiders were trying to unload the stock suggests to me that even within the company, there must be a feeling that the stock price has gone too high. I might live to write this entire put option off, but I'm okay with it. It's not going to mean that I have to change my lifestyle, but I bought a 2-month put option. I'm sure I'll be horribly wrong on some of these investments, and you will let me know if that happens. Some of you, at least some of you, who might obsessively track how wrong I am. But I'm okay with being wrong. The essence of risk is sometimes you're going to be wrong, and at least in this case, I've stayed true to what brought me to this game, which is I believe in value, and I believe eventually value wins out. Let's see if that works out in this case. Thank you very much for listening.